Welcome to the channel. I'm a chartered accountant with deep expertise in international tax and advanced investing strategies. If you're in Canada and serious about building long-term wealth, today's video is essential. We're breaking down a decision millions of Canadians face every year, TFSA or RRSP in 2025. Which one is truly right for you? Let's begin with the foundation. The TFSA or tax-free savings account allows you to contribute after-tax dollars. The magic: every dollar of growth, capital gains, dividends, or interest is completely tax-free. And when you withdraw, there's no tax, no penalty, no impact on your income-tested benefits. Now compare that to the RRSP or Registered Retirement Savings Plan. You contribute pre-tax dollars, meaning you reduce your taxable income today and pay taxes later when you withdraw, ideally in retirement. It's tax deferral, not tax elimination. So what's changed in 2025? This year's TFSA contribution limit has risen to $7,000. Up from $6,500 in 2024. If you've never contributed, your lifetime limit could be around $109,500 depending on your age. That's a serious opportunity for tax-free compounding. Let's look at a real example. Suppose you're 30 years old and just starting to contribute. If you max out your TFSA with $7,000 this year and invest in a diversified equity portfolio averaging 7% annual return, in 20 years your account could grow to over $27,000, completely tax-free. That's $20,000 of profit with zero tax owed. Meanwhile, the same investment in an RRSP would grow the same way, but withdrawals in retirement would be taxed, potentially reducing your net amount to $22,000 or less, depending on your future tax bracket. The RRSP limit is now $32,490 or 18% of your earned income, whichever is less. For example, if you earn $80,000, your contribution room is around $14,400. Now the big question: which one gives you the bigger advantage and when? Let's look at the tax impact. Imagine you're in the 35% tax bracket, a common scenario for mid to high income earners. A $10,000 RRSP contribution gives you an immediate tax refund of $3,500. Later in retirement, if you're in the 25% bracket, you'll only pay $20,500 when you withdraw, netting a $1,000 lifetime tax advantage. Let's break that down. You contribute $10,000 to your RRSP and receive a $3,500 tax refund. If you reinvest that refund, say into your TFSA, you've essentially turned one strategy into two layers of tax efficiency. This is known as the RRSP TFSA loop, and it's a smart move used by high-income earners. But timing matters. If you expect your income to rise significantly over time, it may make sense to delay RRSP contributions and focus on TFSA first, then shift later for bigger deductions. But what if your current income is lower, say $40,000? In that case, your tax rate might be just 20%. The RRSP benefit shrinks and the TFSA becomes the smarter play, offering tax-free growth without future tax obligations. Next, let's talk about withdrawal flexibility. With the TFSA, you can withdraw anytime tax-free. And the best part, whatever you withdraw gets added back to your contribution room in the following year. Here's an example. Let's say you withdraw $5,000 from your TFSA in June 2025. That amount gets added back to your contribution room on January 1st, 2026, not immediately. So if you re-contribute before the new year, you'll trigger an over-contribution penalty of 1% per month or $50 per month in this case. This mistake is common and easily avoided if you understand the timing rule. Always wait until the next calendar year before re-contributing withdrawn amounts. RSPs are more rigid. Early withdrawals are fully taxable and trigger withholding taxes. Unless you're using specific programs like the Home Buyers Plan or Lifelong Learning Plan, and by age 71, you're required to convert your RRSP to a RRIF and begin mandatory withdrawals. Let's explore some common scenarios. If you're in your 20s or early 30s, just starting out in your career, the TFSA is usually your best bet. Your income and tax rate is lower, so tax-free growth and withdrawal flexibility outweigh the RRSP deduction. If you're a high earner, business owner, or incorporated professional, the RRSP is a powerful tax strategy. You shelter income when your marginal tax rate is high and withdraw when it's lower, saving potentially thousands in taxes. In your 40s and 50s, you should start optimizing both. Use your RRSP to manage income tax and your TFSA as a tax-free cash reserve, investment fund, or estate planning tool. For retirees, the TFSA is gold. It doesn't affect old age security, GIS, or other income-tested benefits. Meanwhile, RRSP, RRIF withdrawals are fully taxable and can trigger OAS clawbacks if not planned strategically. A few more key insights for 2025. Inflation is currently around 3%, which will likely increase contribution limits next year. New CRA guidelines have improved TFSA tracking tools in my account, making it easier to stay within limits. And keep an eye on potential policy shifts post-federal budget, especially around high-income RRSP caps or TFSA usage in leverage strategies. The smartest Canadians use both in a coordinated strategy that balances short-term tax relief with long-term wealth building. Here's how that might look in practice. You earn $90,000 a year, contribute $15,000 to your RRSP for the tax deduction, and put your $3,000 tax refund into your TFSA. Over time, your RRSP grows for retirement, while your TFSA becomes a source of tax-free cash for emergencies, travel, or even early semi-retirement. This hybrid approach creates tax diversification, giving you flexibility no matter how the economy or tax laws evolve. To sum up, in 2025, that flexibility has never been more important. We're seeing increased CRA scrutiny on aggressive tax strategies, rising inflationary pressure, and potential adjustments in federal tax policy, particularly around capital gains inclusion and RRSP caps for high earners. By using both TFSA and RRSP strategically, you're not just maximizing returns, you're hedging against legislative risk. For example, if capital gains inclusion rises from 50% to 66%, your TFSA remains untouched, while RRSPs and non-registered accounts could see reduced after-tax returns. Think of it like building a resilient portfolio, not just in terms of asset allocation, but also in terms of tax exposure. The smart move isn't choosing one account. It's orchestrating both to protect your future self, no matter what Ottawa decides next. If you found this breakdown helpful, give this video a like and hit subscribe, especially if you're building wealth in Canada and want clear expert strategies delivered every week. Share it with someone who's unsure where to invest this year, and let's make smarter money moves together. Thanks for watching, and I'll see you in the next one.